Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Cigna Corporation, ticker CI. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $87 billion and an enterprise value of $113 billion. Therefore, you can see there's somewhere in the range of $30 to $40 billion in extra debt on this business that they are leveraging for growth and hopefully higher returns. You can see healthcare providers and services industry. So Cigna Corporation provides insurance and related products in the U.S. So we can take away that basically this is a healthcare insurance company, not necessarily healthcare provider, but maybe that's what they call it here. Product range of coordinated point health services, including pharmacy, benefits management, care delivery, and management. They also have a healthcare segment, including medical, pharmacy, behavioral health, advocacy programs and services for insured and self-insured vehicles. So selling insurance products and providing some other tangentially related services. This beta 0.78 is actually quite low for an S&P 500 company, tends to suggest that it's relatively low volatility. That can be actually quite good for shareholders to find these low volatility businesses. Now, return on equity is interesting here. One thing leaps out to me is that immediately you only have 1 year of losses in the course of a 20-year history. So 19 straight years of profitability for the last 19 years. I really like that. It looks like next year, if it maintains a profitability, you'll be at 20 out of 20 as 2002 rolls off. That looks really, really good. I love to see that in terms of the returns for shareholders. When you avoid losses, it's more likely you're going to have a successful outcome as a shareholder. So 19 out of 20 meets my threshold for potential high quality business. The other thing I see though is that this company, besides 2008, doesn't really have major cyclicality. There is some change year to year, but it's not, a huge up and down. They're relatively controlled, but you do see a general downward trend. I mean, you had return on equity of 30% in 2005, 28% in 2009, 18% in 2012, 19% in 2014, 16% in 2017, and you've kind of been trending down. Now, these numbers are still quite good. Even if you take the last year number that looks like it's at a low, is at 11% for 2021, you're at 9% in 2018. These are all still really good numbers. So long as you stay in that double-digit range, you're going to be turning out well. You're going to have a pretty good outcome. So like what I see here, this all looks actually quite good. Even in 2008, you got down to 7%, but you're back up at 28% the next year. So everything here looks good, relatively high quality. Now, you see some information here. You see the leverage inherent in the business when you go from return on assets of 3.4% to return on equity of 15%. Now, insurance companies are complicated. You're trying to incorporate both return on investment and return on an equity. What you really want is this 15% return on equity, which they are hitting. Again, these numbers are quite high. You're looking very, very good. Because it's insurance, it's not going to be completely stable year to year. That's normal. But you want to see those numbers in that range. So we are seeing the numbers we like to see. Now, PE of 16 is quite reasonable. Anytime I can get, a return on equity of 15%, PE of 15, 16, I'm quite excited. This is all looking very good. Price to sales and premiums are both relatively reasonable here. In addition, you see this revenue growing at 23% a year, premiums growing at 8%, assets growing at 11%, EPS growing at 13%. You're seeing the operating leverage inherent in this business, the fact that they're able to grow so much faster than their assets, earnings growing faster than assets, revenue growing faster than assets. Now, premiums haven't inherently done that, but I'm guessing that they have these tangential services that are growing faster than necessarily the insurance part of the business, and that's okay. But generally, you can see that running very, very well for them. You did see it decrease a little bit in 2021, but look at the difference here. In 2012, this was very clearly primarily an insurance business, and so the insurance business grew from 23 billion in premiums to 41 billion in premiums, but the total revenue grew from 29 billion to 174 billion. So you're seeing massive growth in the business, which has been very, very profitable, because you see this underwriting profit of 10 billion going to underwriting profit of 139 billion, which is absolutely astounding increase. You're unlikely to repeat that over the next decade, but I mean, still tripling your earnings per share in a decade is very, very attractive. And that's even with the decline in 2021 in those premiums. 2020, you're looking really, really good at $22 per share. So This is quite good. I like that I'm at a PE of 16, despite it not being using my peak earnings. So I'm using, an earnings that have come down a little bit. So that's actually quite attractive. And so I really like what I'm seeing here from this business. If you're enjoying this video so far, though, please hit that like button. Don't forget to subscribe. When you ring that bell, you can get notifications as I upload new videos each and every week on companies working through the S&P 500. I'm doing every company. So your favorite company is going to be covered. If you want to see it, you need to be subscribed. Now let's look at the income statement. So again, we're going to have a better understanding here. You can see this big change in the business, right? So you have net premiums earned here, and then you really started to ramp up the fees. So you're earning much higher fees, and it looks like in 2018 and 2019, there was some sort of acquisition or something that changed the overall business, because you went from 11 billion in fees to 112 billion in fees, and that's a massive change. So it's gone from primarily an insurance company to an insurance plus a fee-based business, and that's been very, very profitable for them on the bottom line. Now, what is interesting is they are steadily buying back shares, but you also had a big dilution event. So they bought back shares steadily from 2012 down to 2018, dropping from 290 million shares to 247 million shares. And it's dropping each and every year. That's what you want to see. Consistent dropping, because it means buying back shares is a priority. Now, it did jump to 380 in 2019, but then they've continued to buy back since then. So you're likely to get back eventually to the same share count, if they aren't repeating those acquisitions. But it's been profitable. So despite this massive boost in shares outstanding year over year, you still grew your EPS. That's what you want to see, and that's a really, really good sign for you as a shareholder that this business is being managed well. Balance sheet, I'm going to guess you had a big boost in the debt for that acquisition. And I'm right. So you go from 5 billion in debt to 39 billion in debt for that acquisition. But in addition to buying back shares since then, they've also been reducing the debt load. So I like to see that, saying that they're not just, leveraging up and staying super leveraged. They have that leverage. They used it to grow substantially, and they've been making a positive impact with that. Let's see here. There's not a huge amount of depreciation playing in here, so it still works pretty well. I'm not super concerned about that. Let's see. See this big 24 billion spent in cash on an acquisition. Basically having to raise that with debt. But of course, also issued a bunch of stock from these financings in order to make that work. Although that's looking good. Overall, Cigna looks really exciting for me here. I do have the concern that it's unlikely they're going to be able to repeat this growth. When you have a transformational acquisition like this, it changes these numbers to be faster than the true growth rate. So it would take a little more of an in-depth analysis to determine, what is the growth rate simply for the years since the acquisition, and break the business out into the two parts and really look at it that way. Because right now this number is much faster than the actual organic growth rate, because so much of that was an acquired revenue growth. So it's very difficult to make a determination, really what the difference is going to be from 2019, 2021 forward versus 2012 to 2021. Because this looks like you grew 5x in a decade, and you did, but part of it was acquired growth and not organic growth. So for me, Cigna, I think, would go on my watch list as an insurance company. It is kind of attractive. You do have these nice returns on equity, but it just requires a little bit more work before I'd be comfortable putting money to work in the stock myself. But it's high quality, really good price, very strong growth. Those three things are a nice combination for piquing my interest in the company. If you enjoyed this video, please hit that like button. Don't forget to subscribe. I'm working through every company in S&P 500. And if you want to see those videos, you need to be subscribed so you can get those notifications as I upload them each and every week. Thank you for listening. And until next time, stop paying fees, start building wealth.